Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. The next few videos are going to be slightly different format, a little less official. I have been learning about the options market and I have been selling puts and calls for the last 4 months. I have had some success and wanted to share it with my friends and on the Canadian Money Talk YouTube channel. I will show you the Zoom call with one of my friends, Karma, who wanted to learn about selling puts. Please be aware that I rank options trading as speculation, but if done correctly, it can lead to some nice income. Please also be aware, as the disclaimer at the start of the video says, that options can be dangerous financially, and that you should always educate yourself and do your own research prior to trading options. As a quick preface, I am describing the selling of put options, which are contracts on the derivatives market. This means I am collecting a premium in cash in exchange for promising, having an obligation, to purchase shares of a certain stock at a specific price, called a strike price. The options expire at a certain date as well. I am generally hoping the stock price stays above the strike price, and I do not have to buy the stock at the strike price. If I am forced to buy the shares at a higher price than they are currently, it is likely to lead to me losing money. If I like the stock, I may be fine with being made to buy the stock, but not if the stock has fallen much under the strike price. I generally want the option I sold to expire worthless after I have collected the premium as income, and if I like the stock, I can buy it normally at its market price. I will do a separate official video on options later. And now, on to the first part of the seminar with my friend Karma. All right, so let's start talking about options. So on this call, it's my friend Karma and I'm just going to go through some of the concepts that I've learned over the last 4 or 5 months regarding options. Now, what you see in front of you is the 4 different things that you can do with options, and we're going to concentrate strictly on selling puts, also could be called writing puts. And so you would typically do it if you have a bullish outlook. And there's 2 reasons why you could say 3 reasons why you would want to do the selling of the puts. One is for income. 2 is if you're expecting the prices to go up, which means bullish again. And you could also be wanting to buy a stock at a specific price. And so this would be just as if you're using a limit order. So let's go back even a bit further. So what options are contracts to buy or sell in general a particular stock. And if you are selling an option, you are getting money and you have an obligation. If you're buying options, then you are paying something and you have the right, but not the obligation. So here we're talking strictly about selling. So what that means is that I get money up front, and I'll show you what that looks like in my trading account. And you get money up front, and you end up having an obligation to do something if the purchaser chooses. And what we'll be talking about is the puts, which means it is an obligation to purchase a 100 shares or more from the person that bought the put from you. So I'll show you what that looks like. So you would, I'll blow this up a little bit. So this is for Canada. We have Bank of Nova Scotia, BNS on the TSX. This is just being used as an example. And so once you are approved for options by your brokerage, you get an extra tab or whatever that looks like in your brokerage, and you get something called an options chain. We have calls and we have puts. So again, puts are when I sell a put or when I write a put, I have the obligation to purchase at a certain price. And for that, I get paid upfront. So we'll we'll use BNS as an example. So you can see the current price is $56.18. So typically what would happen is you would have the price up here and you would sell a put down below. And if the price keeps going up, nothing happens and the put will expire worthless. So the person that purchased it is out of luck. You already got your money up front. So this is what it would look like. Let me just kind of show you where are we, account history. So I sell puts all the time. So here we have Emera, and I sold 100 share. Well, so here's another thing that's a little bit strange. So options are always transacted in contracts, and a contract is 100 shares of the underlying stock. So here I did it shows as -2, meaning I did two contracts of 100 shares each, and the price is 54, as you can see in the mouse over, and the expiration date is November 20th. And the commissions, at least at Qtrade, which I happen to be using, is for me it's $6.95 and then $1.25 for each contract. So here where I sold 20 contracts, the commission ended up being a hefty $31.95 because it was $6.95 for me and then another $1.25 times 20. This happened to be a call, but it works the same for puts. And so the reason it's showing as a negative for me is because it's an obligation. And this is how much I got. This is per share. This is in hundreds of shares. Karma, does that make sense?
Yep.
Okay. So it sounds a tiny bit confusing, the multiplication of 100, but really all it means is you have to do your transactions in contracts, but then everything else is per share. So I'm not quite sure why they did it that way. I guess way back when. So for this particular one, I received right up front $164 and 55 cents. The original price would have been 200 times 87 cents minus the commission of 945, which comes to 164. And that money I transferred out immediately out of my account. So the put is again, just to repeat, is you're selling a put, so you're selling and you're getting paid immediately, and you have now an obligation to purchase shares from somebody else. In this case, for Emera, it was at 50. It's at $54. So going back to our Bank of Nova Scotia example, Bank of Nova Scotia is at $56.18, and here's the different puts that are available. Now I can click on here, and of course your interface may be different. I can choose to buy or to sell it. And so the other thing is, you see kind of the green tinge here. So this is in the money. meaning in the money means that the put is above the current price. And as you can see, they start going up in price. So the difference is 50 cents between a put that's $58.50 and a put that's $59. And here you can see that it's 44-cent difference. So when it comes in the money, the puts start having significant value. Generally, of the pretty much it becomes the price difference of the shares. Now here we have a 56 strike price, and so that's 73 a share that is being bid. Apparently, there's sellers who are asking 83 cents. So I'll show you a transaction. So what I would do is I would try to sell this for 80 cents a share, but I would have to do it in groups of 100. And so basically what I'm doing is I'm saying, okay, Bank of Nova Scotia is at $56.18 right now. I would really love to buy it at $55 a share. Or I am saying, I think it's going to go up, and so I'm going to sell a put, and I'm just going to pocket the income, and I'm hoping that it's not actually going to get down to the price that the put is at, right? So selling puts is bullish, meaning you're expecting the price to go up. If it goes down and it hits the strike price that you chose, you end up having to buy the shares. Now you might be happy with that. That might be what you want, and you had perhaps been targeting that price with a limit order, saying, I'm going to buy shares at this price. So by selling a put, you are sort of duplicating the limit order, with the exception that you get a nice upfront premium of, depending on which one we choose, 43 cents, 56 cents, 73 cents, and so on. If I were to try to sell this put, I would try to sell it at 80 cents, maybe. Then I would try to sell it at 79. If still no takers, keep going down. You should be able to sell it at 73, but I would initially try higher. Does that still make sense, Karma? You can ask questions. It's fine. You good?
Okay. Yeah, that's fine.
Okay. Yeah.
I'm just following you.
Okay. Yeah. Just interrupt if you have a question. So Bank of Nova Scotia, because it's a fairly large uh, company in Canada, has quite a few available options. If I'll show you a smaller company which has far fewer options. Now you also have multiple tabs here. So the one that I happen to be on right now, so the expiry is November 6th in 19 days. You can also have a you can do a November you can do a November 20th expiry, which is in 33 days, and then you get another chain. So the price of the put that you're able to get depends on several things, but kind of the main three are: what is the current share price of Bank of Nova Scotia? So Bank of Nova Scotia is at 56. So during the trading day, as the price of Bank of Nova Scotia goes down, the puts become more valuable. So because if I had sold a put at 54 for 55 cents, when Bank of Nova Scotia is 56, if Bank of Nova Scotia goes down to $55, that put now becomes a lot closer to being in the money, and therefore the price here would be increasing.
Mm-hmm.
Conversely, if Bank of Nova Scotia goes up in price, anything down here, like you can see, $44 right now is worth very little because there's such a small chance of it actually hitting in the next 30 days. But 46 is apparently twice as likely as $44, and then so on down the road. And of course, everything here is already in the money. And you can see down here, whoever bought a put for 86 is smiling right now because their puts are worth quite a bit. Okay, and now there's a $2 difference, and there's a $2 difference between the option price. So here they're kind of jumping a little bit. There's a $2 difference here, but there's only a 12-cent difference in the put price. But once you actually get in the money, you can see very regularly there's a $2 difference as there's a $2 difference in the strike price. So typically the way it's done is you have the stock price here and you sell the put down here. But if the stock price goes below the put, that put then starts to be in the money. It starts to be in this green area, and it starts to get nice values. You okay? Make sense? Or did I confuse you? Are you on mute?
Go ahead.
You're still
No. Just having unstable internet connection.
Okay.
Yep.
All right. Well, as long as you can follow.
Yep.
So that's kind of the basis of this chain. So let's say I want to buy Bank of Nova Scotia, but I would want to buy it at $50. So I'm going to say, okay, let's take a safe price, and I'm going to say 13 cents. So I'm going to go to the trusty calculator, and this is how this works. So I'm going to make 13 cents per share. The money in question or at risk, I guess, is $50 per share. So I'm going to divide this by 50. So that works out to 0.002 or 0.2%. But to annualize it, I'm going to multiply this by 365, and then I'm going to divide it by 33, which is the length of time that we're talking about, because these options are going to expire in 33 days. So I'm going to divide this by 33. So if I sell this put at 13 cents a share, I would be getting 2.9% return on that sale. So I would get some cash. Now, what you can do is say, well, okay, let's try what it would be at 56. So if I sold a put at 56, I would be 1.08 divided by 56 times the 365, and we're going to divide it by 33 again to annualize it. So if I'm either happy to buy it at 56, which is just 18 cents below the current price, I would be pocketing an extra $1. So Now, if the price does nothing but go up from here, I'm getting that $1.08, and it's never going to be exercised. I'm never going to have to buy Bank of Nova Scotia at 56, but I will have gotten that premium up front. If it drops down below 56, however, and this is the risk, is that if it drops down to 55, I have to buy those shares for 56.
Mm-hmm.
Okay. So if you're very confident that it's going to go up, then you can sell the puts, and you just collect the premium, and nothing, you don't have to do anything. They're going to expire if it goes up. If it goes down and it hits 56, you have to buy them for 56, and you will have pocketed an extra $1.08 per share for your trouble.
Right.
If it drops down below 55, then you start losing money. So if it goes down to 52, you will have lost $4 in share price minus $1.08. So there's a way of showing how all of these options work. So this diagram here is, so this is a cash secured put. So it's saying the current price is at $60. I'm gonna sell the put at $60. If it goes up, so the vertical here is how much money you're making. This is the share price. So if it stays at $60 or goes up, I make the premium. If it goes up to 80, I just made the premium, and I don't have to do anything. I don't have to buy any shares. If it goes down, however, my break-even point is basically whatever like the premium moves your break-even point down here. But as the price of the stock keeps dropping, my losses compound. You with me?
Yep.
So basically, in order to sell puts, you either have to be right in the direction, meaning you're betting that it's going to go up, or you really want to buy the shares and you're saying, I'm comfortable to buy them at $50. And if it drops below, that's fine, and I'm going to hold on to it.
Hold on to it, yeah.
But there would be a loss. Now, if the price does drop below the strike price, you can and you get the shares, your brokerage will charge you a commission for giving you those shares. You have a choice at that point whether to hold on to them. If you believe that they're going to go back up, you can hold on to them. You just made a small loss, and the premium that you collected offset that loss either entirely or somewhat. Or you could turn around and sell the shares. So you wrote a put at 50, you got your 13 cents. Bank of Nova Scotia dropped down to 48. You paid $50 for shares that are worth 48. You could sell them immediately. Again, there'll be a sales commission. And then your cash loss would only be basically the $2. You could hold on to them, and then if it goes back up, you can keep making money that way if it goes back up.
Right.
So basically, the selling the puts kind of puts you at a risk for a limited amount of time for having to buy something that could be worth less than what you're going to be getting it for. Okay, are you?
As you proceed, then like for further down, like in the future dates, what happens to the bid and ask?
Yeah, so okay, well, the bid and ask is just an indicator of the liquidity. The Canadian options market isn't as liquid as the American is. The American, the bid and ask will be a penny apart.
Mm-hmm.
If we choose a less popular and a smaller stock than Bank of Nova Scotia, you'll have even bigger spreads.
Mm-hmm.
And so the only one that you can really count on, and that's kind of what I do my calculations on, is the bid. You
Okay.
you might be able to put in the sell order at a higher price, and then hope that somebody out there bites. But
Mhm.
this is really the only one that you can count on.
Okay.
And I've put out orders. There were limit orders for to sell the option, and I said, okay, I'm gonna start at, like, for this one, I would start, let's say, at 115. After 10 minutes, I would go down to 114, and then make my way down to $1.10. And if it's not at $1.10, I just, that was my line in the sand, and I'm like, okay, forget it. I'm gonna leave it at $1.10. If nobody wants it, that's fine, and I just let it expire.
Mm-hmm.
So there's different ways of doing it. Initially, I put in the sell orders at this bid, and then yeah, it immediately gets filled. So so there's kind of three things that affect the price of the option. One is the price of the underlying stock. So we sort of talked about that. As the stock moves, so do the prices of the options. So if on Monday, Bank of Nova Scotia from 56 and 18 cents, if it jumped up to 90, then this put would immediately lose value, and
Mm-hmm.
it would go down to under $1 because it's now out of the money, just like these guys are right now. So that's the first thing. The second thing that affects the price of the put is the number of days to expiry. So basically the expiry date, which you can see. Come on, most over. Okay. Anyways, the expiry for this tab is November 20th, so it's 33 days to expiry. So a 56 is at $1.08. If I go down to the December expiry, which it's always the third Friday of the month. So these are December 18th, so 61 days to expiry. Instead of $1.08, it's now $1.72.
Mm-hmm.
So the price of the stock has more time to get in the money. Uh,
Okay.
and so the further out you put it, I don't know why there's a January 2023, but you can see the that this far out, it's now $8.25. And it looks like somebody in the past actually sold and bought a 3-year commitment, basically, or a two and a quarter year commitment.
Mm-hmm.
Um, so the further out it goes, the higher the value of the option. Uh, from what I've learned on the various courses and the readings, most people recommend selling options that are between 30 and 60, maybe 45 and 60 days out, because in the last few days, the time value of the option really plunges. But when there's still some amount of time, the time value of the option sort of goes down fairly slowly. And then the third major thing that affects the value of the option is the volatility. So very low volatility uh, companies that don't move up and down a whole bunch, and Bank of Nova Scotia being one of the big five Canadian banks would be an example. The options, as you see, don't really make you, well, 21% isn't bad, um, but if you choose a smaller company, so one that I have been at is looking at is Algonquin Power and Utilities, and so that one. So if I go out to November, so they have 15 cents. So I'm gonna go 1.5 divided by on a $20 strike price times 365 and divided by 33 to annualize it. Okay, so that one's just 8. So apparently Algonquin isn't that volatile either. So this one's just 8% annualized return, which still isn't bad. Still isn't bad. Now, something to note is that when you're selling puts, you don't own the stock, so you're not getting any dividends. You don't own anything, and so you basically just own an obligation. This concludes part 1 of the Zoom call. Please watch parts 2 and 3 to see the complete seminar. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.